Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, today we're really getting into the weeds on a metric that everyone in finance watches like a hawk: earnings per share. We're going to do a technical deep dive into the key differences between how EPS gets calculated under US GAAP versus IFRS. And for any professional out there, you know these aren't just minor details. They can seriously change a company's reported earnings. So, you might be asking yourself, GAAP, IFRS, how different can one number truly be? It seems so simple on the surface, right? Net income divided by shares. But the answer is very different. We're about to see how these seemingly small rule variations can create some pretty significant gaps in what gets reported, and that affects everything from company valuations to your investment decisions. So here's our game plan. We'll kick things off with the big differences in calculating diluted EPS, because that's where a lot of the action is. Then we'll hit a really key distinction in basic EPS. After that, we'll get into the two-class method for participating securities, and then we'll wrap it all up by looking at the bottom line impact. You know, at a 30,000-foot view, both US GAAP and IFRS are aiming for the exact same thing, giving us a clear picture of earnings per share. They even use a lot of the same tools, like the treasury stock method. But, as it so often does in accounting, the real story is in the technical details.
Okay, so let's jump right into the most complex area, diluted EPS. This is where we have to think about all those potential common shares floating around, things like stock options or convertible bonds. And believe me, this is where the two standards really start to go their separate ways.
So, our first major point of difference is something called contingently convertible instruments, or CCIs. Just think of these as things like bonds that only turn into common stock if a certain condition is met, and usually that condition is the company's stock price hitting a specific target.
And right here, we see a huge philosophical split on when you should recognize that potential dilution. Under US GAAP, if an instrument has a market price trigger, you have to include it in the calculation from day one, period. It doesn't matter if the trigger has been met. IFRS, on the other hand, is much more of a wait-and-see standard. You only include those potential shares once the condition has actually been met at the end of the reporting period.
Let's make this real. Imagine a company issues a bond, and it converts to stock once the share price hits $50. Today, the stock's trading at 45. Under US GAAP, you have to include the potential shares from that bond in your diluted EPS calculation right now. But under IFRS, you do absolutely nothing. Those shares stay out of the calculation because that $50 trigger is still out of reach.
So what's the big takeaway here? US GAAP basically forces you to recognize potential dilution sooner, which often means a lower reported diluted EPS. This is a massive difference if you're trying to compare two companies using different standards.
Okay, moving on to our next point of contention. What about contracts where the company itself gets to choose whether to settle an obligation with cash or with its own shares? How do we guess what they're going to do for our dilution calculation?
This one really shows a difference in approach. IFRS is super strict. It always assumes the company will settle with shares to show the maximum possible dilution, and you can't argue with it. US GAAP, though, has a bit more flexibility. It also starts by assuming share settlement, but it lets a company push back on that assumption if they have a history or a clear policy of settling in cash instead.
And the impact of this is pretty obvious. That rigid IFRS rule can really pump up the number of potential shares you're dividing by, which pushes the diluted EPS figure down. Meanwhile, GAAP's nuance means you could have two companies with the exact same contract, but they report different EPS numbers just because of how they've behaved in the past.
The third big difference in diluted EPS is more about process, but it's just as important. It's all about how you calculate that year-to-date figure across your quarterly reports.
Yeah, this is purely a mechanical difference, but it matters. Under US GAAP, your year-to-date share count is basically a weighted average of the numbers you calculated for each quarter. IFRS says, no, you can't do that. It requires a completely independent calculation for the year-to-date period itself. You don't average the quarters, you recalculate the whole thing from scratch using the year-to-date data.
Okay, let's switch gears for a second. We've been talking about diluted EPS, but let's look at basic EPS. You'd think this would be simple and the same everywhere, right? I mean, no potential dilution to worry about. Well, there's one really critical difference in how mandatorily convertible instruments are handled.
And this is a big one. Under IFRS, if an instrument has to convert into common stock at some point, it's treated like it's already common stock for the basic EPS calculation. Those shares go into your denominator on day one. But under US GAAP, nope, they stay out of basic EPS until they actually convert. So the bottom line is, for any company that is issued these kinds of instruments, their basic EPS under IFRS will be lower right from the get-go. It really shows how IFRS takes the view that if a conversion is a sure thing, you should account for it immediately, even in the basic number.
All right, let's tackle our next complex topic, participating securities and what's called the two-class method. This whole thing kicks in when a company has other securities out there, not just common stock, that get a piece of the dividend pie, like certain types of preferred shares. The method basically forces you to split your earnings between the different classes of stock.
And the key differences here come down to scope and how you handle losses. US GAAP casts a much wider net. It applies the two-class method to any instrument that participates in dividends, even if it's technically classified as debt. IFRS is way more narrow. It really only applies to specific equity instruments. And on top of that, GAAP is crystal clear. You only give losses to these other securities if their contract says they have to absorb them. IFRS is kind of quiet on that point.
Now, these technical rules have a very real impact. Under GAAP, way more instruments can get dragged into this pretty complicated calculation. And think about it, if a company is losing money, that difference in loss allocation could mean that common shareholders end up bearing a much bigger piece of that loss under GAAP than they would under IFRS.
Whew, okay, we have covered a ton of technical ground. So let's try to boil this all down to the most important takeaways for all you financial pros who actually have to deal with this stuff day in and day out.
So, if you're ever comparing companies across these two standards, there are really three huge differences in EPS accounting that you absolutely have to keep in mind. First, how those contingently convertible instruments are handled. Just remember, GAAP is more aggressive. It includes potential dilution way before the triggers are met. Second, the treatment of mandatorily convertible instruments, but in basic EPS. IFRS puts them in from day one. And third, remember that the scope of the two-class method is just way broader under GAAP.
And at the end of the day, this is why it all matters so much. We're not just talking about academic differences or rounding errors. These subtle technical rules can fundamentally change the final EPS number. And that in turn can throw off financial models, valuation multiples, and your ability to make a true apples-to-apples comparison between global companies.
So I'll leave you with this question to think about. Let's say you're in the middle of a cross-border M&A deal. How might these accounting nuances change how you value your target company? Simply slapping a PE multiple on their earnings could be dangerously misleading if you don't dig into the nitty-gritty accounting behind that all-important E in EPS.